Markets have seen a volatile week following fiscal stimulus announcements. How do we trade a market like this? That's the discussion I'm having with Peter Hugg, Global Trading Director of Kitco Metals. Peter, welcome back to the show.
Good to be here again, David.
Peter, earlier this week, President Donald Trump announced that he would not cooperate with the Democrats in coming out with a fiscal stimulus plan before the election. The following day, he backtracked by saying certain sectors like airlines would receive stimulus. And now, just today on Thursday, House Speaker Nancy Pelosi countered that by saying that she would not approve a targeted stimulus plan without a broader stimulus bill. Markets are slightly up on the news. What's the impact on the markets overall?
I think, as I mentioned last week, I think the metals need one more injection here of, or at least are expecting one more injection of stimulus. And I think this is bad news, not only for the short term in the metals, but also in the equity markets. I don't think there's going to be a significant washout in the metals. But with the anticipation of further stimulus expected, especially after Trump reversing his position yesterday, the markets took that as a positive cue, and silver and gold bounced. As soon as Pelosi made the statement, I think about an hour ago, indicating that she wasn't interested in targeted stimulus, only in a comprehensive package, the metals started to sell off, and I think that's just a reaction of people again becoming nervous and moving some of their assets into cash.
So as of 1:30 p.m. Eastern time, stocks are still up. Metals haven't done anything. They've kind of just been flat. Gold is flat. Silver is flat. So it seems like the markets are shrugging this off for now.
Well, again, it depends on your time window. I mean, if you're a trader, the markets have moved. Silver was trading north of $24 at the opening this morning, and gold was flirting with the $1,900 level, and you've got gold back at about $1,884 as we speak, and silver down about 40 cents at $23.70. So if you were a trader and you were along this market in anticipation of the fiscal stimulus, you're not happy right now. Overall, from a chart perspective, there's no significant damage yet. Gold needs to break down below 1850 before there's technical damage on the charts, and silver needs to close below 2325 before there's probably going to be more selling. So from that perspective, yes, it's basically a muted response. But the stock market tends to have a delayed reaction on things like this. So the key is watching that equity market. It's been trading pretty much in tandem with the metals. And now there's a bit of a divergence. You have the metals softer, whereas the equity market is still sort of holding ground.
What's your view on the fiscal stimulus? Do you think we'll get some sort of stimulus package before the election? It's only a couple weeks away, Peter.
Again, a week ago, my bet was that there would be no further stimulus package before the election. I'm still going to hold that bet. This is a political shell game right now, and the Democrats are trying to figure out if they don't help here with the U.S. economy, does that hurt them in the election, or does it hurt the stock market in the short term, and that makes it more difficult for Trump to get reelected on equity markets at historic highs. And it's a dangerous game. I mean, the economy needs a fiscal injection. The Fed Chair Powell has made it extremely clear in the minutes and in his briefings and in his news conferences that he is expecting and needs or wants more help from the government relative stimulus in the economy. He is concerned. The problem now is if nothing happens before the election and Trump does not get elected, it's likely that we're not going to see any stimulus until sometime next year, February, until the new administration takes over. And in that context, there is some serious risks to the economy. So there's a lot at stake here. I would hope that they would get their act together and at least provide some stimulus for targeted industries. But the Democrats and the Republicans are so divided and so far apart that I think the odds are that we're not going to see anything before the election.
Don't you think it's actually in their political self-interest to push for stimulus as much as possible? I'm talking about both parties. The Republicans obviously have an incentive to curry the favor of their voter base, while the Democrats obviously don't want to look like they're not trying to give aid to the people. So it just seems to me like the gridlock doesn't make any sense.
I totally agree with your conclusion. I mean, I think the Republicans have more to gain if they can come up, with a large stimulus package before the election. I think that's going to be beneficial to the equity markets. And you could make, and then they can make the case, look, the economy is recovering, you've got the equity markets at all-time highs. Give us another 4 years and it's going to be much better starting in 2021. You would think that would be the same argument that Democrats could put on the table. Look, we don't want to really give Trump any help, but at the same time, we don't want to look like we don't care about the American people. And if it's perceived the Democrats have stalled this fiscal stimulus package and nothing comes back to the market for 4 months, they run the risk that the American people are going to say, you're the guys that caused this drop in the stock market for political reasons, and you are not helping us out, especially the airline industry. And it's, and I have obviously deep empathy for the employees of the airline industry. But there is a much bigger picture here. I mean, if the airlines run into continued significant issues and they take planes off the tarmac, there is a whole logistical issue that then now starts to affect the economy because airlines carry a lot of freight. So this is a big problem. And I think what they're doing, the two parties, is absolutely disgraceful. But it's an election in less than 30 days, and it's political. And so it's anybody's guess what they're going to do.
Now, Peter, this week was a wild ride for the markets, both equities and for gold and silver. Tuesday saw a big drop in equities and gold when Trump announced that he wouldn't cooperate with the Democrats anymore, but then he reversed on that the following day. Equities regained their losses. As a trader, how can you even be positioned for such volatility? We're talking about 1.6, 1.7% drops and then 1.8 gains the following day in the S&P 500. Those are big moves.
Again, I can't remember how many times I've said this, but it's been a number of times over the past 6 weeks to 2 months. Holding a core position in metals makes absolute sense. I would not liquidate your metals holdings positions if you are an investor and it forms part of a balanced portfolio. Being a trader in this market, I mean, I can't even find the words to describe how difficult it is to trade this market. Normally, a trader, when they go into a position, they usually either have a fundamental or a technical reason to enter the trade. Generally, if you're a good trader, you'll ride your profits and you'll raise your stop losses and trail them against your profits. If you're a bad trader, you should at least have the brains to put in a stop loss. The problem with putting in a stop loss in these markets is, where do you put the stop loss in? When Trump made the announcement on Tuesday, I believe, again, every day's like Groundhog Day again, but I think Tuesday when he said that, when he told his Republican caucus that they should break off talks with Pelosi, I mean, silver dropped $1.40 in less than 2 hours. Gold dropped almost $40. Normally, you put a stop loss in a dime or 15 cents below your entry point if you're a trader. Generally, you'll get knocked out. Maybe it'll cost you an extra dime on the stop loss. Here, you put a stop loss in. If it doesn't trade at that price, you're not out. And next thing you're looking at is a price that's $1 lower on silver. If you're a trader, you're not trading 100 ounces of silver. You're trading size. So trying to trade this market as a rational trader that has disciplined stop losses in is extremely difficult. Most traders that I'm aware of that are in the industry that are trading from the perspective of hedging positions with their clients, i.e. people that trade for financial institutions and or coin dealers or metals dealers that sell product to their clients. Most traders, if they were smart, basically would try to keep a flat book and try to maximize their revenue on volume and margin / spread. But taking a principal position over and above that, to me, makes no sense. It's like rolling the dice. you could give up your whole day's trading profits on a retail basis just by being on the wrong side of a principal trade. So we don't spec, we don't take positions. We basically hedge our positions that our clients create for us when they either buy or sell metals to us. And we live off the margin of the spread between our offer bid to the clients relative where the market is. And we think that's the most sane way to go in a market that has this volatility.
But why would you be holding on to metals in a time when this week, for example, the correlation between metals and equities is quite strong? Tuesday, for example, when stocks sold off, so did gold. And the following day, they both rebounded. How do you play this kind of positive correlation in a market like this?
Well, I mean, you play it exactly for the reasons that you just gave. I mean, if you believe that the equity market and the metals markets were correlated, and they have been for about 4 weeks now, and both markets are moving off a basis of fiscal stimulus and continued stimulus being added to the economy, which will also translate into a weaker dollar, you would, based on what Trump said on Tuesday, take a long position. And if you took the long position, you were right. It moved higher. As of this morning, everything looked like there was going to remain to be at least targeted stimulus. And then, Pelosi comes out and says no, and the market goes back down. So when you're a trader, you can't just put a position on and then shut your book. I mean, you're watching things develop in real time. You're trying to assess what the rational response is going to be by the market, if it is a rational response. And then if you are going to take a principal position, then you make a decision whether you should enter, exit your trade, or whether you want to be flat. And you're going to be right. And anybody that tells you I'm a trader and I'm right 9 out of 10 times is an absolute liar. It's just not true. I mean, when I used to run a wholesale trading desk for a bank way back in the day in my previous life, if my traders were right 6.5 to 7 times out of 10, that was an exemplary performance. So again, all you've got to do is hopefully be right, like going to a casino 51% of the time, and you'll make money as a trader.
Peter, would you make the statement that gold is behaving like a risk asset right now?
In the context of it, if it's sort of mirroring the equity market, I would make the statement that it is. But there are, I consider the metals almost a cash reserve. And when the market gets nervous, it doesn't necessarily mean the equity market needs to drop, but if there is something that comes out that scares the market, the first human tendency is to generate cash. I mean, that just tends to be the psychology of investors as a group. Now, there are certain groups that when this type of anxiety occurs, they run into gold. That's not always the right thing to do, in my opinion. And perfect examples are 2008, when the first financial collapse happened, gold dropped. March of this year, gold dropped $200 before it gained its legs and went back up. The first general reaction of an investor when he's scared is he moves to cash. And you want liquidity, and you've got the best liquidity you have, in my opinion, is the metals. Gold trades 24/7, extremely liquid. So if you are worried, and in today's environment where you have tweets and news flashes coming out literally by the second, that anxiety grows. And as the anxiety grows higher, some people will liquidate and move into cash. So you get this kind of volatility in the market, people just uncertain of what's going to happen. And they just lighten up on their positions. And that would include lightening up on your equity positions or lightening up on your metals positions. And that creates the volatility. The overall macro picture for the metals, unless we go into a major depression and the stock market loses 50% of its value and unemployment jumps up to 20% again and the economy literally goes into depression, In that context, I would be very, very bearish the gold market. Cash becomes king. In a market where we still have growth and fiscal stimulus from at least a perspective of the central banks being at zero, it's very difficult, not from a macro perspective, looking at the precious metals markets and considering them highly undervalued at current levels, with much more upside room in the medium term, medium to longer term, but certainly by the end, starting already, in my opinion, by end of October, going through the year end, I would tend to see the movement being higher. So, in that context, you've got to, if you're an investor, you would still be holding your metals positions. As a trader, I mean, again, you've just got to have a lot of guts, and you've got to have a lot of discipline to be able to trade this market and come out of it at the end of the day without being a total wreck.
Peter, you mentioned being constructive on the metal in the medium term, but in 2016, following the last presidential election, what we saw was a month of dollar strength in November going into December, which brought down gold prices. Could this happen again this time?
You got a Republican president elected in 2016, without making a comment on whether it was the right president. Generally, when a Republican is elected, they tend to be pro-business. The market takes that as a positive sign. Trump's platform was he was going to remove regulation. He was going to rebuild the American economy. And it was, a very sort of a bullish perspective by investors. And that's why you saw that move back in 2016. Whereas, the Democrats are, there is some concern that they're socialist. They're going to roll back put back in the regulations that Trump has taken off. They may open it up again to China. U.S. jobs may be lost. So, the Democrats tend to be more of a, at least perception-wise from big money, a drain on the liquidity and the free spirit of the markets. It's really a matter of psychology. And when a Republican gets into office, it tends to be positive for the markets.
Perfect. Thanks very much, Peter, for your thoughts. I appreciate it.